Hello, today is Wednesday, the 28th of October 2009. Hope everyone is doing magnificent. Stock market's hitting in today. S&P down 1.9%. The Dow down 1.2% and the NASDAQ down 2.7%. So a big difference, NASDAQ being the worst, Dow being the better of the three, and S&P right in the middle. There was a company that came on that lost 10% the first day they were on the NASDAQ. Don't know if that was one of the reasons or not, but it mainly covers the sector of technology, mostly, not always, but mostly technology related stocks. The Dow Jones only tracks 30 large cap companies and the S&P caps 500 different companies. So normally when you want to look to see which is the best for the markets, the Dow and the NASDAQ really don't cut it, the S&P would. But apparently to Bob Pisani or the writers for CNBC that gave Pisani the information, I guess the Dow just means more. Most people see the Dow as the #1 indice. Yes, it may have more historical data, but it doesn't track quite as much. He came on to the show this morning stating, well, we're only down 2%. Normal retracement is that of 4%. It's not time to get worried. Everything's fine. It pretty much sounded like this was a time to buy on a dip, if you will. And the interesting thing was, at the end of the day, the S&P 500 was down 3.44%. Not 2%, yet he gave the number of the Dow. Now, after today's loss, the S&P 500 is down 5.5% from the highs last Wednesday of a shade over 1100. Moving on now, the Dow Jones, the S&P 500, what happened today, it ripped through the 50-day moving average fairly convincingly. Now, unlike the 5-day moving average, you need a lot more time to see exactly if this is going to be a level of support or if in fact it will become resistance, the 50 will start to decline and go lower. When the 50-day moving average declines, that's usually when more fear sets into the stock market. The 50-day moving average will decline when its closing price is lower than its closing price was about 50 days ago. Pretty much that simple there. So there's still a little bit of work to do for that to be declining. This is the third time it has made a test of this 50-day moving average since it started rallying this year. The last 2 times were successful tests. We'll see if this is a third successful test or the third move was the failed move. The gold fund, it closed at around 1030 and its high is 1069.70, which means that it is down about 3.7% from its highs. Still a little bit from the 50-day moving average, but a 2% drop, at least by the first part of tomorrow, will get it to the 50-day moving average. Possibility where we may find support, but the biggest area for support on gold is going to be that 1,000 psychological number that has proven to be a big level. It was resistance for quite some time. It finally managed to get above it and stay above it. A test of the 1,000 to me is pretty much only guaranteed, or it is at least about 80-85% likelihood, if not higher, of happening. So it could test this area pretty soon, and maybe gold might even go up to 1,100-1,200 and then come back to 1,000 later, but I don't think so. I think it's going to test that 1,000 relatively soon. Yesterday on Cramer's Mad Money show, I didn't watch much of it. I watched about 4 or 5 minutes of it, and what I seen was a caller called in. He said he bought this stock. I didn't write it down and I didn't record what I had watched. But he said that this company has been losing form. He wasn't too sure what to do. And then Cramer pretty much ended the conversation very quickly. Only spoke for about maybe 10, 12 seconds. Said, oh, everything's fine. Just hold on. And then pretty much was like, Oh, in Cramer we trust, while taking it to commercial break. Now, what I find very interesting is today on Stop Trading with Aaron Burnett, he comes on stating that he is expecting a top in the market for the rest of the year, meaning the S&P 500 shouldn't go above 1100 for the rest of the year. Now, if that was the case, that would sound very contradictory to say hang on to a stock when I don't think the S&P 500 is going to make new highs. That just really doesn't make sense. But what do you expect from Mr. Cramer anyway? Home sales were down 3.6% for the month of September. It was up 1% in August. An economist on the show was stating, man, I'm surprised that it actually went down, because I was thinking that with the first-time home buyer incentive that it should probably have gone up. Well, that might be the reason why it was going up so well over the last few months in the summer. But that's a key thing. It's a seasonal type of industry. Houses sell better in the summer, and they don't sell as well when you get into the fall and the winter time and early spring. It's mainly a late spring, summer, and early fall type of higher amounts of sales. So it really isn't that much of a surprise, and the first time homebuyer credit has made these numbers better than what they are, and in a sense they pretty much are in artificial numbers, like most of the government numbers I would suspect to be. They said on CNBC today that Visa has more transactions than ever before. A lot of them are still the new debit Visa cards. But this is just inevitable that the credit card companies like Visa, MasterCard, and American Express are going to go through these difficult times because of the theory or the facts of how money is created and how the debt system works. You can't pay off debt, at least not the majority. Yes, some people may be able to pay off debt, but most people only get higher into debt. And it just seems inevitable that the credit card companies are going to have very, very difficult times. On TD Ameritrade, they said today that they are handling 410,000 trades per day. Wow, that's a big number. That would work out to $4.1 million in sales per day based on their costs that they advertise of always $9.99, or we'll just say $10 a trade. So this is showing you how many people enjoy to play online gambling, if you will. And that's pretty much exactly how I see that as. I mean, a lot of it is day traders making 10, 20, 50 trades a day. And if you're very good at it, then it's like being a really good poker player, basically. They said on a CNBC article that there are signs of a recovery because few companies like Starbucks and American Express are matching the 401k plan. They're bringing it back. They're saying it to be a sign of recovery. I see it to be a sign of increasing invisible gambling, and I really use the word invisible because a lot of people who are putting into this are seeing this as investing and not gambling. But however, if you are getting a matching plan, theoretically it's very difficult to nominally lose on the situation. As if, say for example, you put in say $1,000 into stocks and they put in 1,000, then theoretically as long as stocks don't go down 50%, you're going to at least break even. Nonetheless, they still may go down over 50%, and most likely it will take a while for that to happen, but stranger things have happened into this world. I really don't see that too much as signs of recovery. What I really see is I see the signs of recovery article that was posted out, the earlier statement by Bob Pisani stating this morning that it's only a correction. We normally only lose 4%, so it's no time to be in doom and gloom mode. When I'm hearing that, and I'm not hearing them say, oh, we could be going lower, Because that's really what I was looking for. That's why I watched CNBC for about 2 hours today, was to see if they would have any remarks for the stock markets going lower. And I really didn't hear too much about it. So to me, that tells me that the chances of a top are very decent. Yes, Jim Cramer did say that he's expecting a top in the market. And I was very surprised to hear that. And when I did hear that originally, that reduced my chances of that actually being a top. But then I think, well, what did he say yesterday about this one company who has been doing poorly? Oh, continue on holding. So that was a very contradictory statement in my opinion. So we'll wait and see what transpires from this. The markets are oversold on the short-term basis, so don't look too much into the rally. In order to see bullish signs back again, we need to see the 5-day moving average flatten out and go higher. And we are well a ways away from that 5-day moving average. So if you see tomorrow that the Dow is up 120 or something, it could be a dead cat bounce. And maybe it will end up being a dip on the 50-day moving average. Time, of course, will only tell. I was just not too enthusiastic of seeing markets going higher when it really didn't find much support today at that 50. So I'm going to end it at that. Thank you all for watching. Peace and light, and have yourself a great day, everyone. Bye-bye.